Well, good afternoon, and thank you for all coming to what I hope and believe will be a very interesting 10-year review of the Insurance Act. We've got a distinguished panel of speakers. They're each going to speak on two aspects: what's changed under the Act and what were the intentions behind the changes, firstly, and secondly, what's happened since the Act came into force. Has anything really changed? Have things improved? Have problems been encountered? The panel members are going to start with David Hertzell from Mactavish, giving you an overview as to what were the intentions behind the Act, and in the interests of finishing on time and moving swiftly to that, I hand over to you, David.
Fascinating for me to have an opportunity to speak at this event, because I guess a lot of you here are much closer to the coalface than I am these days. It'd be interesting to hear what your experiences have been of operating under the regime of the Insurance Act. Just to try and set the scene a little bit with what occurred at the time and why we did what we did. This was actually the last in a series of 3 insurance law reforms that the Law Commission did at about this time. Firstly, the Third Party Rights Act, then the Consumer Insurance Act, and lastly the Insurance Act 2015. And it wasn't really a coincidence that this came up. It was in fact the 3rd time that insurance law had come to the Commission or its predecessor. And the reason for that really is, frankly, a statement of the obvious, that the Marine Insurance Act, and there is a clue in the name, was drafted back in 1895, I think, certainly at the end of the 19th century. And post-war, post-Second World War, the UK was nothing like the country that it had been then. The whole kind of economic and social structures were different. Everything had changed. There were just very many more things to insure. And in effect, non-marine classes were probably a larger part of the market than marine classes, which I guess had been larger back in the day. And there's a general view that the law was outdated in view of these major changes. And the thing that really was a bit of a spur post-1980 was the introduction of, or beginning of the introduction of IT, because it became possible to store, manipulate, and deal with data in a way that did change the information balance in the market in a way that certainly hadn't been the case back in the 19th century. Now, one of the issues we faced was that the Marine Insurance Act 1906 is actually a marvellous piece of drafting. It is very, very clear and beautifully done. That made it very hard for judges to develop the common law within that framework to keep up with the pace of economic and social change. They were rather stuck with what the Act said. And you could see that we ended up in a bit of a sort of unhappy position because we started to develop industry codes to correct what were perceived as unfairnesses. An ombudsman was set up. The SCA, no, not strictly dealing with all of this, had other issues too, but that came into being around about that sort of time. And that kind of indicated that things were not entirely comfortable. More of a problem, to be honest, with consumers, but nonetheless also applied it in the commercial market too. And a lot of cases were being heard through arbitration. So that again hindered the development of the common law. So over a period of about 8 years, I think I spoke to everybody who ever unwisely expressed an interest in insurance, however tangential. It was really a very long and detailed consultation that we carried out, both with normal Law Commission consultation papers, but also many issue papers that focused around specific things. So it was quite a detailed investigation into what the market said. We did have some underlying principles when we did this, and the first really is a blatant piece of commercialism. There was at the time an increasing number of straws in the wind saying, be careful about bringing your business to London, because people were feeling it was an unfriendly jurisdiction for claimants, business holders, and if they could go somewhere else, they were being encouraged to do so. And we felt that's pretty bad for the UK in the sense that this is a major part of what UK PLC does. It's a huge industry for this country. Another issue we had to deal with is that whilst we hived off consumers into their own pot, which made life a lot easier, nonetheless businesses are of very, very many different shapes and sizes, from a one-man band up to some really complicated multinational. And it wasn't possible for us to draft anything which incorporated all those different aspects. The level of knowledge, the economic activity is just completely different. So this is a default regime. The 2015 Act is a default regime. You don't have to follow it if you don't want to. It's what happens if you don't contract out of it. It was also prepared on what, I guess very loosely, I could call a principles basis, in that we set out what we wanted to happen with some examples and some sort of framework around it, but we did not try and cover every jot and tittle. It wasn't a regulatory piece of drafting. It set out the principles that we'd hoped to achieve, and if there were gaps, we expected the court to come in and fill those gaps, but actually there hasn't really been very much activity on that front. We carried forward the 1906 wording sometimes. You would not expect to see a modern drafted statute which includes some of the phrasing that's in this one, but that's because it meant something. And if we wanted that meaning, we kept that wording. So if you see things like prudent underwriter and material, etc., it's because it meant something important to the market and we carried it forward. We wanted to encourage professionalism, and you'll see there in the Act that we do a couple of times place an expectation on all parties, but including the underwriter, that they know what they're doing. So if you write a particular class of business, you're expected to know about that class of business. You cannot just be naive capacity. And I think, slightly diverging from what my chairman said here, we didn't completely abolish the principle of good faith. We took out the remedy for it. But we did say these contracts do remain contracts of good faith. And actually that's important, because the way people behave will be judged against a higher standard, or certainly a good faith standard, than might otherwise be the case. And the final thing I would say before I hand on is that we never felt it would be appropriate for us at the Law Commission to dictate to a highly successful market how the law should affect and run their businesses. So what we did was to incorporate into legislation what we were told was best practice. And I guess time will tell whether we got that right or got that wrong, but that was what we intended to do. We did not dictate to the market how things should be done.
Thank you very much indeed. Subject to following speakers, I think we can all agree that the Law Commission did an absolutely fantastic job in the consultation and drafting, very careful, with support of other organisations. And I'm going to pass on to one of the co-hosts of this evening, that is 7KBW, together with the London Market Association, Arabella here. I'll pass on to Harry Wright from 7KBW to introduce the topic, duty of fair presentation, knowledge of the insured and insurer. Harry.
Well, writing in October 2014, before the Insurance Act came into law, this is what one person thought about the proposed law reform, and which isn't entirely consistent with what we've just heard. The bill is likely to create as many problems as it solves, not least uncertainty. It's overextended itself into areas where there is no need for reform, the law on attribution of knowledge being the most obvious. Lawyers will be drooling over the years of litigation which the bill will almost certainly yield. It is bad news for insurers and insureds. Now, if you're wondering who the learned author of that very gloomy prediction was, it wasn't in the Daily Mail. I'm embarrassed to confess in front of David Hertzell that it was me. And based on what has happened over the last decade, I am very pleased to say that I was completely wrong. There has not been some rash of litigation about any aspect of the Insurance Act. Two of the largest insurance disputes we've seen recently, the FCA test case and the recent Russian aviation dispute, there was almost no mention of the Insurance Act at all. And as the Court of Appeal acknowledged just last week in the Scott beef case, which you're going to hear more about, there has been very little authority on the 2015 Act to date. So we all know that barristers' predictions can occasionally be wrong, and my article was certainly a continuation of that tradition. In my defence, I didn't approach this in a completely neutral spirit. I was instructed at the time by Case and others at the LMA to advise them on all the potential problems that this bill contained. So I was on the lookout for problems, not for the benefits. And that probably explains why I was being unduly pessimistic. But anyway, my topics today briefly are the duty of fair presentation and knowledge. And I want to focus mainly on knowledge because the most significant changes in relation to the duty relate to the remedies, which Joe is going to cover. But as for the duty, under the Marine Insurance Act, the insured had to disclose all material circumstances known to it and not make any material misrepresentations. And really the essence of that duty is largely unchanged under the Insurance Act. It's been rebranded as a duty of fair presentation, and there are a few subtle differences. One being that you can discharge the duty not by actually disclosing the material circumstance, but by giving sufficient information to signpost a prudent insurer that they need to ask some more questions. That's a slight dilution of the duty, but not, I would suggest, a major one. I have come across insureds saying that they fulfilled the duty by doing that. And there's one Scottish case called Young and Royal and Son Alliance where it was argued unsuccessfully that had happened. But really, it hasn't made a great difference in my experience. So really, the changes to the content of the duty have not been particularly earth-shattering. So I turn on to consider knowledge. Why does knowledge matter? Well, it matters because under the duty of fair presentation, the insured only has to disclose something that it knows. And it does not have to disclose something if the insurer already knows it. So it's a very important part of the duty of fair presentation. And I want to just illustrate the way it worked before and it works now with an example. A piece of software was installed on the IT system of a bank in 2005. And at the time, the manufacturer sends a long and detailed manual to the bank, which says somewhere in the middle of the manual that the software is at risk of cyber attacks if it's not regularly updated. And the diligent head of IT reads this manual and then makes sure they update the software regularly. And then he shoves the manual in a filing cabinet and it's forgotten about. That was all in 2005. 20 years later, the head of IT is on the beach having a pina colada because he's retired. And the new head of IT, who is not a very diligent person, has taken over. He doesn't even find the manual, let alone read it. So he doesn't know about this risk. So he doesn't tell the head of insurance about the risk. So he doesn't pass it on to the insurers. You can see where this is going. There's a devastating cyber attack. And the insurers decline the claim for non-disclosure of the risk that was described in the manual. So there's an issue. Did the insurer, did the bank know about this risk from the manual or not? First, let's think about the old law before the Insurance Act. This question was governed by sections 18 and 19. And the important test there was that the insured was deemed to know every circumstance which in the ordinary course of business ought to be known by him. Now, in my example, the bank is not very diligent in the ordinary course of its business because the head of IT didn't look back at the historic manual from the filing cabinet, so he didn't know about the risk. So under the old law, it seems, the bank does not know about this risk and therefore didn't have to disclose it. And on one view, which is supported by some of the older cases, the old law effectively takes account of the fact that some policyholders are not very efficient, they don't run their businesses in a very efficient way, and that should be taken into account when you're assessing their knowledge. Under the Insurance Act, the position could be different. The insured's knowledge is defined by 3 tests in Section 4. First of all, the insured will know what's known to its senior management. Now, there's a lot of scope for dispute about who senior management is, and this is one of the rare areas we've actually had some help from the courts already on this. A decision of Mrs. Justice Dias in the Win-Win, where she had to decide whether a nominee director of a one-ship company was senior management. Lots of people in this room were involved in this case. And she decided that he wasn't senior management. She said that usually board members probably would be, but it was a question of substance, not a question of titles. And on the facts of that particular case, he didn't qualify. So his knowledge that he had been prosecuted for being involved in heroin smuggling was not something that the claimant knew, and therefore there was no ground for the avoidance. Now, in my example involving the bank, nobody in the senior management knows about this manual that contains the warning. So that type of knowledge can't arise. The second type of knowledge, the bank will know what is known to those responsible for its insurance. That includes the broker, but also people within the bank, like the head of insurance, who look after the bank's insurance. But again, in my example, those people don't know about this manual, so that kind of knowledge doesn't arise. And then the third source of knowledge under the Insurance Act, the bank will know, and you have to slightly hold your breath before saying this, what should reasonably have been revealed by a reasonable search of information available to the insured. That replaces the old test of what the insured ought to have known in the ordinary course of business. And that's potentially a significant change, I think. So should the warning in this manual that's been buried in the filing cabinet have been revealed by a reasonable search? Well, there's obviously going to be a big dispute about that. On one view, the information is available to the insured because there it is sitting in the manual in the filing cabinet, and it might be thought that it should reasonably have been revealed by a reasonable search, and that reasonable search shouldn't really take account of the fact that this bank happens to run its business in an inefficient way. So the bank might well be held to have knowledge of what was in the manual. But equally, one might say that the reasonable search shouldn't require the insured to delve deep into the filing cabinet of 20 years ago and read some long document which has long since been forgotten, because that would be a very burdensome thing to do. And so perhaps the warning in the manual is not something that should have been known to the bank. The outcome is obviously going to be highly fact sensitive, but potentially this is a significant change brought about by the Act, because what the insured knows and must disclose could well be subject to a more rigorous test than it was previously. But there's a reason I'm using this silly, fictitious example about a bank and somebody drinking pina coladas. And that's because, as I noted at the beginning, there just hasn't been a deluge of disputes in the courts about this sort of an issue. Only 2 cases have even mentioned Section 4. One is George On High Limited and Alan Boswell Insurance Brokers, and the other is the recent Scott Beef case. But neither of those cases really decided anything significant about Section 4. So I think really the answer to all of this is that we are going to have to reconvene in another decade to consider whether anything really has changed about knowledge.
Thank you very much indeed, Harry. Joe Higgs, also from King's Bench Walk, is going to speak on remedies for breach of the duty of presentation. Joe.
Well, as you all know, prior to the 2015 Act, the only remedy afforded to an insurer for breach of the duty of good faith by an insured was avoidance of the policy ab initio. And where the breach was fraudulent, the insurer was entitled to avoid the policy, keep the premium, and indeed was entitled to repayment of all claims paid to date. Where the breach was not fraudulent, but negligent or innocent, the insurer could still avoid the policy, but in those circumstances had to refund the premium. This all or nothing avoidance remedy had for many years been criticised as an inflexible rule, which could potentially operate very harshly towards insureds, given that the insurer could avoid a policy where there had been a wholly innocent breach, and given that the non-disclosure could have nothing to do with the loss that had occurred. It was thought that the remedy was out of line with the normal compensatory principles that underline the approach to remedies. So unsurprisingly, given that long-standing and pretty much universal view, the Insurance Act reformed the remedies that were available to the insurer. Avoidance remains a remedy, but only in certain circumstances. And the Act introduces other so-called proportionate remedies. The first point to note is just a point of terminology. The Insurance Act introduces what's called a qualifying breach. The insurer only has a remedy against an insured for a breach of the duty of fair presentation if the insurer can show, and the burden is on the insurer, that but for the breach, the insurer would not have entered into the contract of insurance at all, or done so on different terms. And that is called a qualifying breach. Now, although that's new terminology, you'll all know that that is nothing new, because the effect of these provisions is simply that the insurer has to prove inducement before they're entitled to any remedy. And that was obviously the position under the old law, as was confirmed in Pan Atlantic. And it remains the position. But when it comes to the remedies that the insurer has for a qualifying breach, and those are set out in Schedule 1 to the Act, there has been a significant change. Avoidance of the policy ab initio is now only available where either the insurer can show that it would not have entered into the contract at all if a fair presentation had been given, or the breach is deliberate or reckless. And again, the burden is on the insurer. Where the insurer would have entered into the contract, but they would have done so on different terms, then the insurer is not entitled to avoid the policy anymore. Rather, those terms are to be treated as applying to the contract of insurance. Now, that could obviously still have the effect that a loss is declined. For example, an insured fails to disclose a flooding history. Had it disclosed that flooding history, the insurer would have imposed a flood exclusion. The effect is that the policy will be treated as including that flood exclusion, and therefore the insured will not be able to claim for losses caused by flooding. Where the insurer would have entered into the policy but would have charged a higher premium, then again the insurer is not entitled to avoid. Instead, it can reduce proportionately the amount to be paid on a claim, reflecting the higher premium which would have been charged. I think at one point the Law Commission were flirting with the idea of deducting the premium from the amount of the claim payable, but they moved away from that and rather went to a proportionate reduction in the claim to reflect the amount by which the premium would have increased in response to a fair presentation. So in a nutshell, that's what the Act provides. It's a fairly straightforward, easily comprehensible scheme. What have the courts decided? Not much as yet, as Harry says. There's only been a small number of cases that have come before the courts to date which have concerned the duty of fair presentation at all. There was a Scottish case that Harry mentioned, Young and Royal Sun Alliance, in 2019, but that was principally concerned with the question of waiver, and the question of the remedies wasn't really at the front of the court's consideration. In England, there have been a couple of cases over the last few years. The first English case was a case of Berkshire Assets and AXA in 2021, and it was a claim for property damage and business interruption following a flood. But the non-disclosure here wasn't about a flood. Rather, the insurer alleged that there had been a failure to disclose that one of the directors of one of the insureds had been subject to criminal charges. The judge held that that was a material circumstance and that there had been a breach of the duty of fair presentation. Now, in relation to inducement and what it would have done if a fair presentation had been made to it, AXA was able to adduce evidence through various underwriters that it would not have agreed to provide cover for the relevant insured at all. And AXA was able to point to a specific and recent practice note issued to underwriters, which said in terms that if the client disclosed criminal charges, the risk was not acceptable. The judge accepted the underwriter's evidence, held that the insurers would have declined to provide cover for that insured, and as a result, they were entitled to treat the policy as not covering that insured. And the Court of Appeal duly refused permission to appeal against that decision. So that is a case where the insurers were able to show that they would not have provided cover to the insured. There have been two subsequent cases in which the court has considered the remedies available to the insurer, both in 2024. One of those was a decision of the Chancery Division, Tynefield and the New India Assurance Company. Again, that case involved non-disclosure about a director. The insured had failed over several years to disclose the fact that one of the three individuals operating the business was a de facto and shadow director, and that he had previously been the director of a company which had gone into administration. And the court held that the failure to disclose those circumstances amounted to a breach of the duty of fair presentation. And again, the insurer successfully established that it was its strict policy to refuse or cancel cover for insureds whose directors had an insolvency history. Again, there were underwriting guidelines which the insurer was able to point to and which assisted the insurer in persuading the court of what it would have done in that hypothetical situation. So again, in that case, the insurer was entitled to avoid the policy. The other case is one that Harry has mentioned, which is a decision of Mrs. Justice Dias in 2024 called the Win-Win, or Delos Shipholding and Allianz. And that was yet another case concerning non-disclosure of criminal charges against a director. As Harry has said, that was a case where knowledge was one of the main questions, and the judge held that the insured company didn't have actual or constructive knowledge of the circumstances. So her further comments relating to the insurer's non-disclosure defence are obiter comments. But it's a very interesting judgment in relation to the question of what an insurer would have done had a fair presentation been made. Having heard the evidence of two underwriters, which the judge described as illogical and confused, the judge then decided that had proper disclosure been made, the insurer would have required the replacement of the relevant director as a precondition to cover. So she found that the insurers would have imposed a term, and she held that the insurance was to be treated as containing that term. But interestingly, she then went on to say that she also found that the condition would have been complied with by the insured, and the result, therefore, would be that the insured would be entitled to cover. Now, that's actually potentially, arguably, inconsistent with something that the Law Commission said in its report. And so it will be interesting to see what happens to this case, because it is going on appeal and the non-disclosure issues are going on appeal, and the appeal is to be heard in July this year. And as Harry mentioned, there are various people in the room who are involved with that, so they can tell you later what's going to happen. So where are we? We haven't had many cases from the courts. Has anything changed? Yes, undoubtedly, because the remedies available are different, and the courts have shown themselves willing to explore in detail the question of what insurers would do if a fair presentation were made to them. And they've been prepared to grant remedies which reflect that. Have any problems come to light? Not really, not yet. But I would sound sort of three notes of caution or advice for various people in this room. One for brokers, one for insurers, and one for everyone. As anyone who's a broker will have realised from the cases I've just been through, there has been a rash of cases involving failures to disclose insured directors' insolvency histories and or criminal charges and similar behaviour. The case law establishes very clearly that in general, circumstances of that nature will be material. And in my experience, insureds, even sophisticated commercial insureds, do not realise that. And I do think that all brokers should be making that very clear to insureds, or brokers may find themselves on the end of negligence actions in due course. For insurers, the lessons learnt to date are that contemporaneous underwriting rules, manuals, guidance, notes are going to be very helpful in showing what the underwriter would have done if proper disclosure had been made to it. And for everyone, watch out for the Court of Appeal's decision in the Win-Win later this year, because it will be the first appellate decision in England in this area, and it promises to be a very interesting one. And that's all I wanted to say on remedies.
Thank you very much indeed, Joe. We're going to move now to the subject of warranties and terms not relevant to the actual loss to be delivered, some remarks to be delivered by Christopher Foster of Holman, Fenwick and Willan. It's an area close to my heart. I remember about 35 years ago spending a lot of time in the basement of the Middle Temple Library researching the question whether a warranty was analogous to a repudiatory breach, so as to require acceptance and only to give a remedy as from the date of acceptance, or was it automatic? And we established in the then House of Lords that it was automatic, and Section 10.1 of the 2015 Act rightly reverses that and consigns it to legal history, and nobody will ever have to spend so many hours in such a dusty place again. I'll hand over to Christopher.
Let's start. What is a warranty? A warranty is a promise or an agreement by an insured or a reinsured that a state of facts or a state of affairs exists or will exist. Now, in the olden days, before the Act, a breach of warranty has serious consequences. Automatically, from the moment of breach, the insurance was voided, and it was voided regardless of whether or not the insurer or indeed the reinsurer suffered any prejudice as a result of breach. So take, for example, a locks warranty in a property policy, a simple warranty. All locks will be put in operation when the premises are unattended. Back door left unlocked. Burglars go through the front door. Answer for the insured. You've lost your coverage because you left the door unlocked. Now, it is right to say that many insurance companies and indeed Lloyd syndicates would not take that sort of point. But it is also right to say that some would. Indeed, there's one lawyer here with whom I had this very argument, or who was involved in this argument, where I was trying to argue that should not be the position because the back door was not locked because it was a mortise lock and a fire door, it would have been illegal. But the point was taken. The other point that was occasionally taken or used was what became known as basis clauses.
Yeah.
Basis clauses because the words, the representations in the proposal, or the proposal itself shall be the basis of this contract, were interpreted as transforming representations in proposals, or whatever was referred to, into warranties. And the beauty of that from an insurer's perspective is that you don't need to get excited about knowledge or inducement of an underwriter. You simply had to demonstrate that the particular fact that was warranted was wrong and you lost coverage. So a very onerous term, previously kicked out for consumers, they are made ineffective by the Act. And the other thing that the Act addressed was the determination of cover. And in principle, although the courts occasionally reached this conclusion as a matter of construction beforehand on certain wordings, but in principle now, every warranty is suspensory in nature. So provided you can remedy the breach, or at least put the risk into essentially the same as that originally contemplated, you can restore cover as an insured. So to take a sprinkler warranty example, warranted that the insured shall install a sprinkler system within 21 days. Day 22, it hasn't been put in. There is then no cover, at least for fire. Day 30, the sprinkler is installed. The cover is miraculously restored. Even if there is a breach of warranty, the Act introduced a new protection for the insured for what I'm going to term risk mitigation provisions. Warranties or other terms which go to reduce the loss. So locks, warranties, alarm clauses, all those sorts of clauses. What the Act does is it allows the insured to prevent the insurer from relying on the breach if the insured can show that non-compliance with the term, wait for it, could not have increased the risk of the loss which actually occurred in the circumstances in which it occurred. And I'm pretty confident that was high up in Harry Wright's Armageddon of disputes provisions. It means that in my prior locks warranty example, if the burglar goes through the front door and it's the back door that's left unlocked, the risk has not been increased in those particular circumstances. If the burglar goes through the back door and does so with some sort of sledgehammer, that would be picked up by the warranty. But importantly, it's picked up by the warranty regardless of whether the breach has caused loss. The mere fact that the locks warranty in those circumstances could have reduced the risk of loss sufficient. You don't need to demonstrate that actually had the lock been in place, there could have been some different outcome. 10 years, one case, Mock against Argo, a very tedious dispute. I think the judge reputedly fell asleep a few times during it, without meaning to defame her. But actually, and decided against the insured on grounds other than the breach of warranty. So Obiter comments. And in the case, simplifying it, there was a storage warranty that the storage tank had been not only inspected but certified. And what had happened was it hadn't been certified, and there was then an argument about how some water got into some fuel and rendered the fuel unusable. As I say, the argument from the insured was certification made no difference. Judge said, obviously rightly, that the combination of inspection and certification addressed or could have reduced the risk in the circumstances in which the loss occurred, regardless of whether certification did or didn't. So would have found against the insured. One final point to address, which has been discussed, I think, in the market. Can you get around the law on warranties through describing your terms other than as warranties? In other words, probably as conditions precedent, or drafting them in a way other than labelling them warranties. Now, that has been addressed a week ago or so in the Lonham and Scott Beef case. Simplifying the facts, there was a condition, or what was described as a condition precedent in a liability policy, that the insured would trade on its standard conditions, which obviously had limitations of liability and the like. It didn't. And the Court of Appeal had no difficulty in analysing what was described as a condition precedent, as a warranty, and indeed as a condition precedent, as both, but a warranty for the purposes of the Act, and applying the consequences of the Act, which was that coverage was suspended at that time, so the insured got no cover. I'd like to pretend it's one of those cases which has been subject to lots of articles, lots of lawyers trying to pretend it's just desperately interesting. But the reality is that it's perhaps rather simple and reflects the drafting of the Act and the examples that were given, which are the clarity behind the Act, lots of discussions, explanatory notes and so on.
Thank you very much indeed. Lastly, we're going to hear about a subject which wasn't originally going to be in the Act, I think, but is there, namely damages for late payment. There were concerns that it might be used as a way of, in a rather American way, to vex insurers, but I'm not sure it has been, and look forward to hearing from Alarella Ramage from the London Market Association very much on that.
Yes, so I've landed up with Section 13, the unlucky section of the Act to talk about. It was something of a surprise to the market, and certainly to those of us that were involved in discussing the Act with David, to find this suddenly introduced into the Insurance Act, if you like, through the back door, through the Enterprise Act 2016. There'd been a lot of debate about this provision, and I suppose just looking at the cost-benefit analysis that was done at the time, it sort of highlights the concerns. At the time, under the old Insurance Act, there was no implied term that you had to pay within a reasonable time. Other jurisdictions had started to introduce requirements upon insurers to pay within a reasonable time. And some of the debate was around trying to bring us into line with the other jurisdictions. On the other hand, I don't think that any evidence was produced at the time that insurers were actually being slow in paying. In fact, I think to the contrary, the London market was held up as being pretty quick to pay compared with other jurisdictions. So there was a balance of views on this. David, quite fairly, on the Law Commission side, said you needed to be allowed, insurers needed to be allowed a reasonable time to investigate losses. And he also said that it was important to the long-term stability of the insurance market that insurers have incentives to investigate and root out fraudulent and invalid claims. So the arguments were finely balanced. On the other side, there was a push towards incentivising insurers to pay fast, to give insureds legal rights to enforce prompt payment, and also to set out the sort of compensation to which they were entitled. So imagine our surprise at the point that this was introduced, and I think most people felt like we might well at this point. If you look at the clause, it's an implied term of every contract of insurance. That the insurer must pay any sums due in respect of that claim within a reasonable time. A lot of people felt this was a cliff edge, and that we would be faced with claims on a similar basis to the sort of bad faith pleadings that you see in the American courts. And I think Harry probably put out another article on this, along with lots of other insurers, as to what a disaster this was. In fact, there's only been one case coming out of this section, Quadra Commodities, and that was decided in favour of insurers. So we've actually had no cases decided against insurers where it's been found that they took too long to pay a claim. On the other hand, I think if you look at the cost-benefit analysis that happened at the time, the advantages that were put forward, it was felt that there would be a saving of £1 million a year to insureds on the basis of reducing late payment cases from 400 to 100. And on the other hand, it was anticipated there might be costs for insurers of up to £100,000 a year in increased litigation costs, and possibly up to £375,000 across the whole market, ongoing annual costs for underwriters to investigate unmeritorious claims for late payment. Now, I don't know about the £1 million reduction to insureds, or in terms of that benefit coming through in faster claims. I think claims possibly are being paid faster, possibly because of better claims systems and other things, but there's been no evidence produced. But for insurers, there actually has been, I think, a much more significant downside than was anticipated in the cost-benefit analysis, because although there haven't been any actual claims, any judgments against insurers, there has been, and it's reported by most people that a claim for late payment is sprinkled into most claims that come to insurers, and time and money is spent on dealing with that aspect of the claim. So my suspicion is that the anticipated 100,000 and 375,000 probably falls short of what actually is happening. In the one claim that was decided in terms of lessons for insurers, although the insurers were not found liable for late payment, the judge did suggest that they should have got on pretty quickly with appointing surveyors and assessing the claim, and I think that's a sort of general lesson and something that people should still be trying to do. I do wonder whether going forward it might be a sensible thing for people to consider dividing claims for late payment of damages, for late payment of claims, into the actual case insured against insurer on liability, and then subsequently, only if the insurer loses the case, should you actually be having to spend any money on dealing with a 13A claim. That's probably all I've got to say on 13A, given that there isn't any case law for me to get through.
Very interesting. Thank you very much indeed. But I think, David, it's over to you to sum up whether the Act has lived up to hopes and expectations. Do you repent over Section 30?
We were all surprised and something it made the cut, actually. We didn't approach all this with quite the pessimistic view of Harry, but we did approach it thinking there might be some litigation after the event, because there are a few things in there which are to some degree a hostage to fortune. Senior management, I think, was an area we thought there might be some litigation about, because it's very much a fact-based thing, and it has been that the one case mentioned. What is a reasonable search? Because that will bound to result in some case law, but no. What is a reasonable time to pay a claim? No, not really. And what is the causal connection required between a loss and a risk mitigation term to ensure that term is effective? The very point that was made here by Christopher. Again, very little. And all these things we thought did need some sort of expansion, some sort of interpretation by the court. So it has been quite surprising, really, that we have had only the number of cases, and often quite peripheral, obiter points that have come up. Proportional remedies, I think, perhaps was more significant than we all anticipated at the time. You're quite correct, Joe, that this hall of mirrors that's been promoted in Win-Win was something we said shouldn't be the case. But I think I did see a couple of mediations, and it made me think perhaps that did work quite well, the kind of proportional remedies. There's a situation which I'm sure is familiar to all of us, where you have a policyholder who is either a little bit negligent or perhaps a bit sharp, really. You've got a broker who was a bit keen to get the commission in and rushing things a bit, and the underwriter who probably should ask some questions but was out to lunch on that particular day, and it didn't happen. Most of the time, 99 times out of 100, who cares? The year goes through and nothing is a consequence. On the one or two occasions when it is of consequence, everybody is pointing the finger at the other party. And proportional remedies prove quite effective in making people realise you're not going to walk away from this, and nor are you going to recover 100%. So you might as well talk. And that does seem to have smoothed out litigation, which perhaps was unnecessary. And certainly anecdotally, talking to people in the market, those sort of classic avoidance arguments around non-disclosure and misrepresentation are far fewer, or in fact non-existent, it would appear, than they used to be. So that was a little bit of a surprise to us. It's probably, I mean, it sounds completely ridiculous after 10 years, isn't it? But it's probably too soon to say how the Act has finally worked out, because we are dependent on the time lag factor from 2015 until something happens, and then on the willingness of people to litigate whatever that something is. So you are somewhat dependent on what occurs. And maybe 10 years is quite swift. But on the whole, we are, I think, well, speaking for my colleagues at the Commission, pleased that there has been a reflection of what was told to us as best practice does appear to have actually represented best practice in the way that things have worked out. Maybe we'll say something different in the next 20 years, but up to this point, that does seem to be the case. So we're pretty pleased with the way things have gone.
Excellent. Well, thank you very much, and thank all our speakers.